The spring selling season is officially upon us, but with more auctions planned and more of us taking advantage of record low interest rates, it means house prices, especially in Sydney and Melbourne, could soon become out of reach for everyday Australians. Here to discuss, New South Wales real estate editor Tim McIntyre and John Arnott, ING Direct's Executive Director Customers, joins us also. Gentlemen, a warm welcome to you both. And of course there are a number of discussion points arising from this situation. The first being, of course, that the Australian housing market is becoming its own two-speed economy, especially with Sydney and Melbourne really charging ahead and other capital cities just slowly growing. Tim, how extreme is this?
Well, it is a case of Sydney and Melbourne really leading the way, and they're basically the only two capital cities that are above the national average for growth and performance over the last year or so, but they're the ones that are holding it right up. The others are just plodding along, some are recovering and some are on their way down, like Perth.
Yeah, and John, is this being reflected in the financing side of real estate as well, the mortgage market?
Absolutely, it is very much a case of location, 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 and we're seeing stronger demand for people looking to buy in those particular areas and those particular cities. Not only the cities themselves, but also the pockets within those cities. Very strong demand in certain areas with close proximity to CBD, etc., etc. Is
it because of the capital growth potential that they want in? Because the price is just so high.
I think there's capital growth protection. There's also a strong work-life balance people want to strike. Obviously proximity to the city, shortening that commute. People are looking to really get into the areas which give the best reward in terms of lifestyle. Other factors include, school catchment zones, etc. They're really driving the areas of popularity, which is the supply-demand mix is driving up the pricing.
Do you think that property valuations are becoming stretched too far?
I think there's certainly a very conservative lens on property valuations. I think we're absolutely keeping a close eye to make sure that they are prudent, not only on the valuation of the property today, but we're also being very prudent on the assessment for customers when we're looking at how much we lend them moving forwards, to make sure we're doing the right thing by the customer and not overstretching what they can afford. We take a longer term view as opposed to not just what they can afford today based on the current low interest rate environment.
Yeah, right, because obviously prices are so high. Who's buying if everyday Australians can't afford these $1, $2, $3 million properties just for your average 3-bedroom family home?
Well, in some of the hotter markets, we're finding a lot of equity is responsible for people buying into markets and either adding to their investment portfolio or helping kids out get into the market who haven't been able to save their own deposits. But investors now make up around about 50% of the new mortgage market. I know that in New South Wales or specifically in Sydney. So investors are looking to get in just like everyone else with those low interest rates and get in while they can, and it's creating more competition.
Are investors flipping these properties quite quickly because of the capital growth, or are they investing for the longer term rental return?
Look, most smart property investors out there will go for a long term hold. The flip and sell can happen in mining towns and areas like that is a bit better, but they want to get in now while the low interest rates and the repayment options are there, and they can get it as close to capital positive cash flow as possible, and then go from there, hold it for 30 years, and they go through another couple of cycles basically.
All right, we're talking more this weekend because I'm going to put some money where your mouth is, maybe.
Right.
John, what do you make of the RBA's warning of a potential housing bubble risk?
Well, look, I think certainly the increase in prices in the recent times going up really quite sharply. It's always prudent to make sure that we are thinking about the longer term. I can't comment whether there's a bubble or not. All I can say is that property prices have gone up considerably, and with a low interest environment today, it's important that customers look at what they're borrowing, look at their affordability on a longer term basis, because if there is some drop in property prices, they need to make sure they're in a strong financial position to be able to absorb that.
And of course, Governor Glenn Stevens of the RBA pretty much leaving it up to us to sort out this housing price crisis, I suppose, in the Sydney market anyway. Yep. Pretty uncertain of moving on interest rates because the rest of the country will be affected by that.
Absolutely. Look, interest rates right now are at a historic low, and it's certainly an attractive. People are fixing their loans now for relatively long duration compared to historic averages. They're locking in for 5 years on great rates, and those rates and the affordability over the next 5 years is making people take the plunge and have a look at property. Other asset classes are not performing as well, so if people have got the cash and they've got the boldness and the desire, they're moving there quickly and they're looking at property.
Tim, People are starting to whisper or worry that the Australian housing or property market is starting to mirror that of the US pre-2008 liquidity crisis and subsequent GFC, global financial crisis. What do you make of that?
Oh, look, I'd say that's not the case at all, Moira. The US is a much different housing market to Australia, always has. You have a lot of cities around the US which are custom built on the back of industries such as Detroit, with car manufacturing, and those sort of places, they really lost a lot of value in their homes because their industries suffered in the GFC, and that didn't have as much. I guess their loan structure is a lot different, and like things are a lot different since the GFC, and a world apart in Australia.
Yeah, John, just because consumers are concerned, they are worried, they don't understand. How does the loan, or I guess the lending market, differ in Australia and since the GFC to what we saw in America?
Yeah, look, building on Tim's point, I think it's absolutely critical to note that banks these days, they ask for a lot of detail when assessing a customer's suitability or affordability to repay a loan. That is very different to what was happening in the US. What was low doc mortgages that we used to describe here in Australia, they've pretty much been certainly not common anymore, or the price of low doc mortgages is significantly higher. So banks we're very prudent in making sure we truly assess a customer's potential to repay the loan on a long-term basis. Very different to the US. It was a lot easier to get a loan with very little documentation. There's a lot stronger due diligence goes into understanding a customer's ability to repay in the Australian market. So very strongly regulated in that particular area.
Indeed. So what happens, boys, when interest rates go up? There is talk, of course, by economists and experts out there in the marketplace that we will see the average interest rate with a 4 in front of it in the coming sort of quarters, half year.
Yeah. I'll go first.
Yeah, okay.
When interest rates do go up, there'll be a little less demand for properties because you won't be in an environment where you can pay the loan off as easily. A lot of the demand has been created, especially in places like Sydney and Melbourne, because people know they can save a couple of $100,000 on their mortgage compared to historical rates of averaging a 7 or more. But people need to remember, especially those overextending themselves now, that it's very unusual for interest rates to stay this low for any amount of time. So when they do start to go up, and they will, prices will come off the boil, and people won't be crowding into auctions and going $200,000 over reserve on a plain family house anymore.
Yeah, just building on that, I think it's important to recognise that a lot of customers, they've been assessing their affordability of their loans based on previous interest rates. Now, while rates have been coming down, customers have been holding their repayments at previous levels, so they've actually been creating almost a natural savings buffer within their mortgage. Now, that will allow them, if interest rates do go back up, they've got the capital there, they've got the protection there, they've been saving in their loan, their loan to value ratios are lower, so they are certainly protected to that extent.
So some protection, it's not going to be a bust as some people are worried about.
For Australians who have had houses for over the last 3 or 4 years, when they took out their loans when interest rates were higher, I think it is a different situation for people who are borrowing now. They're entering the market on a rate, starting with a 4 in many cases, and that's certainly where there needs to be some concern to plan for the future ahead, to make sure they don't overstretch themselves. And I think it's important when they're taking out finances, Australians always remember to think long term. It's not a short term game.
All right, gentlemen, thank you so much. Appreciate it.
Thank you.
Thanks. Pleasure.